Hi, this is Shashank Mehta. I'm the founder of Equity Math, a wealth firm based out of Mumbai. At Equity Math, we focus on connecting our end clients with asset managers with the right portfolio strategy that they most resonate with their investment temperament. Today, here we have Mr. Arpit Shah, co-founder of Care Portfolio Managers, also known as Care PMS. Care PMS is a SEBI-registered PMS based out of Mumbai. They are known for their boutiqueness and their ability to find multi-baggers. Thank you for this opportunity. I hope we make the most out of this interview by asking all the right questions that allow investors to know more about Care PMS. Let me begin with asking you, what is the journey that Care PMS has taken over these 13 years? What is the background of the founders? How it all happened? If you could give us a flashback.
So first of all, thank you, Shashank. Thank you, Equity Math team, for having me on the show. So journey of Care PMS goes beyond 2011. So it is more than 13 years. It is almost now 2 decades where Care PMS came into existence. So I was client of Jayant Mamanya, our co-founder and fund manager. So we were doing very good on the research side. And at the same time, because of our research, we were having very good temperament in the market. And during that time only, we were seeing people who were making very huge losses. That time, Lehman and all thing happened. So I brought idea to Jayant Bhai that this is a bridge we can build whereby we can provide our services and make retail investor money out of the markets. In 2007, we got the license, but due to SEBI's change in net worth criteria, we had to surrender within 6 months. We recapitalized our company in 2011, and since 2011, rest is the history. In 2011, I approached to Amit Doshi, who was then working with PwC, and Amit is my college mate. So I approached him, I pitched this idea to him that, see, we are good on the research side, but also need someone from the very professional background. And you can say it is a young mind, because between me and Jayant Bhai, there is 20 years gap. So Amit happily joined the company. And so far we crossed 1,000 crores of AUM and delivered around 22% CAGR. That means if a client has invested 1 crore in 2011 with us, right now his portfolio is 14 crores.
What has been the top 3 learnings over your journey in Care Portfolio Managers that you believe would have enriched your investment wisdom? If you could also explain this with real examples, that will really help us understand.
So in the market, what happens then when you are having investment into small cap, which can be potential multi-bagger, and company starts performing well. Okay, so normally what we are observing is that people start booking the profit or people start exiting at different point of time. At Care PMS, we learned that, if your conviction is playing well, you can go more aggressive. And that's what, we have been doing. Let's take an example of, say, a company called Arvind Limited. When we started buying somewhere in 2023, it was quoting at 120 rupees. We had that advanced material division valuation. So that story was playing out. I'm not going much in detail right now. But Arvind, when it went up to 450 rupees, and at 400 rupees also, still we are buying it. So instead of booking the profit or reducing the stake, if our conviction is playing well, you can go more aggressive. And that is, I think, one of the best learning of Care PMS. We have observed that if one of the 20 stories is playing well, better to have faith in the story and don't look at the market price. The second learning is that, currently what is happening, the market will be always in the pendulum. It will go from the extreme bull run to extreme bear phase. And in bear phase or in the correction, people starts allocating more of their investments to the large cap or probably the mid caps. Our learning has been that in the bear market, this is the actually right time to churn your portfolio and invest more into small caps, because small caps provide you that opportunity that that can outperform the broader market in longer term. So like what we did from 2024, mid 24, before election, we started allocating, since market was crossing new high every day, we started allocating some of our investment to the large cap. And at one point of time, we were having around 25% exposure to the large cap companies, large and mid cap companies. While now in 2025, when we are seeing that almost 80% of the companies have corrected more than 20%, we are churning our portfolio and shifting our large cap part to the small cap. So this is another learning. The third, I think, is more kind of a personal observation, that having one multi-bagger in the portfolio is good enough to give you excellent returns. We are delivering 22% CAGR since inception, and able to identify at least one multi-bagger in every year. So that has actually worked very well. So I think these three wisdoms, what we have got from the market.
So the top 3 learnings of care portfolio managers are to consider going aggressive, meaning you can consider increasing your weight on a certain stock even at increasing prices. That will pay off. Second, eventually small cap would generally outperform the broader market. So in a market that is downtrending or in a correction mode, one should consider taking exposure in small cap and mid caps rather than trying to play defensive and go into large caps. And the third learning that they've seen, and this is a personal observation of Arpit Bhai, that at least one multi-bagger is required in the portfolio. While they have had a track record of identifying multi-baggers in each of the past 13 years, the key learning is that it is that one or more multi-baggers in the portfolio that gives you an alpha of a few hundred basis points in the overall CAGR that you generate in longer time frames. Sir, 30% of Care PMS clients are NRIs, primarily based out of the UAE.
Yeah.
How do they see Indian listed equities? How do you see India as an opportunity? What do you pitch? How do you think India is going to fare over the next 1 or 2 decades? Would you be able to dissect this for us to learn this better?
So if you know that in large economies, India is the fastest growing. It is outperforming all other large economies by far big margin. Like USA is growing low single digit. China has reached to its saturation. India has a potential to go to the higher single digit, or even early, the 10 or 12% kind of GDP growth we can see in next 2 decades. That is possible. We are finding foreigners, NRIs, even the large part of the Europe, everyone is looking at India for the investments. Retail participation is increasing. As you know that, we have still reached only 15% of working population who are investing into India. So there is huge gap is also possible there. Untapped market, what we can say. So there are 3 parameters in any story that needs to be played when you are making investments. So one is fundamental. The second is liquidity. Third is valuation. So for next 2 decades or so, fundamentals of India are fantastic. It looks very nice. Atmanirbhar Bharat, domestic consumption stories, those all are yet to play. From export-oriented economy, we may have domestic consumption, domestic manufacturing economy. There are many things that are happening. Our demographic distribution is very good. So fundamental, I don't think there is any problem. Liquidity, as I just said that, it is only 15% of the working population who are investing into listed space. Very big untapped market is there. So if we say even 30 crores more demat account will open within India, and per account only 1,000 rupees is coming. So we will have additional inflow of 30,000 crores in say next 5 years. So that will give tremendous help to, for the markets, to the markets. Third is a very subjective concept. It is about valuation. So which valuation is good, which valuation is bad, that will be individual's call, and that will keep fluctuating. So our focus will be more on on identifying when there is a saturation and at what time we should be more conservative, and at some time when we can go more aggressive. So that will be based on the valuation. First two things we don't have to do anything.
What would you say are the key differentiators of care portfolio managers? What sets care PMS apart, and possibly the salient features, as you may call them?
So care PMS has always remained very conservative valuer. And why this is salient feature is because when you have a portfolio fund which is having more than 70% exposure to small cap, and in small cap either indices or at company level, in the bull market your valuations are skyrocketed. While at care PMS, even at every peak market, our weighted average PE has remained under 25. So we are very much concerned about the valuation, which is, I think, uniqueness about care PMS. We are very conservative valuer. We may have 5 years projections, which normally any small cap company may have, but our valuation is based on the recent financials. So in that perspective, we don't give much weightage to the projections. The actual delivery is what we are looking for. The second feature about care PMS is that we are very aggressive investors. Though we have around 20 companies in the portfolio, our top 5 or top 6 companies will always have weightage of above 50%. So that helps us to outperform. So on valuations we are conservative, but on the portfolio construction, if I have built a conviction on particular company and that is playing well, I don't mind going it up to 12%, 13% of the portfolio. So that are two features. And third, and the most important would be that we would like to call ourselves as early identifier of that, any trend reversal. We identified some trend reversal in mining companies 2 years back. We made very good money out of it. Recently, we have early identified textile industries, and now you see, everyone is talking China plus one, Bangladesh plus one, and textile is talk of the town. So trend reversal is something that care PMS is able to identify early.
So the key differentiator of care PMS, or the salient features, as Arpit bhai explained, are one, that they are conservative valuers. So the weighted average PE of the portfolio is generally 25 or below. Another important point is that they generally give more emphasis to current PE versus forward PE. So that's again being slightly more conservative. The second point is that they're aggressive in their portfolio strategy, in the sense that while they have 18 to 20 companies in their portfolio, but the top 5 or 6 companies would generally have about 50% or more weightage. And the third, care PMS has had a track record of identifying trend reversals or cause and effect. The moment there is some change in the macro or some change in a government law, they're able to identify what would this create an impact on a stock or a sector, and they've had a track record of early identification and taking benefit of that trend. So you explained about how care PMS portfolio strategy is slightly aggressive, with about 5-6 stocks out of the 20 having more than 50% weightage. But could you explain a bit more in detail about how all of these stocks actually form the portfolio construction process from idea generation to exit?
Answer will be a little lengthy because there are many things to be communicated at this point of time.
Okay.
First, we have two different teams. One is research, one is IC. What we observe that since we ourselves are involved into research, at the time of research, we get somewhat biased about a particular company. So what we have decided is that research, like now we have a research team of total 7 people. So research meeting happens in different time frame, and then out of research, wherever there is a buy call, okay, that company gets discussed in the IC, which we call investment committee, and IC takes the final call, and that helps us to remove that confirmation bias while doing the research of a company. Now the process of identifying a company or searching for the company to ultimately ending it with part of the portfolio and exiting. So I'll share that journey, how this happens. Majority of our investments are bottom up. Majority, when I say, it is about 85 to 90% of our company selection is based on the bottom up approach. In bottom up, normally like result season, on an average per week we evaluate around 300 to 400 companies across all these 7 people team. Of these, where we see something is happening, like some traction in the financials or some traction in the good commentary from the management, etc., we start evaluating this. And fortunately nowadays, lot many conference calls and peer evaluations and analyst calls are available. So we go through this. Then out of these 250, 300 companies, we shortlist 20 companies for further research. Of these 15, 20 companies, probably one of the director, like myself, either Jayan Bhai or Amit, within 3 of us, we get involved with the management, interacting with the management, do more deep research. Sometimes we may go and visit the plant, etc. Of these 20 companies, most likely 1 or 2 companies per quarter we filter to have in the buy category. So that falls a part of the portfolio. In buy category, we have at least 3% weightage in particular company, at least. As and when company starts delivering on our expected lines, we don't mind having higher exposure. So if any company like Arvind Limited, as I spoke to you few minutes back, we started by 3% exposure. Now then we increase up to 10% gradually, as and when our conviction started playing well. At one point of time, what happens that either that company's weight in the portfolio is so big that I have to trim down, or valuations is fairly matured, or there is change in fundamentals. Either of the case, we trim down the exposure, or sometimes if company doesn't play as per our expectation, we don't mind shaving off it completely, having it complete exit. But before we invest, we have at least 4 to 5 years time frame in mind. So that is about bottom up approach. In top down approach, we normally identify the sectors that is going to do well. We normally buy 2 or 3 players in that particular sector. 2-3 companies in that particular sector. So portfolio is mix of both top down and bottom up, and exit strategy is same for each of the company. And this is how the life cycle of a company from the research to the part of the portfolio to exit.
Under portfolio construction, CARE PMS has an investment committee rather than an individual taking any decision. And with respect to building the portfolio, when they select a portfolio company, they start generally at a 3% weight and then slowly scale it up. They also have a defined exit policy, as Arpit Bhai explained. So that sums up the way companies enter and exit the portfolio. Sir, when you say that CARE PMS are conservative valuers, could you elaborate a little bit more on this?
Yeah, so CARE PMS, while constructing the portfolio, takes care of growth stocks and as well as the value stocks. So let me give you one example. At the peak of the bull market, our weighted average PE has not crossed even 25 times of its earning. A fund which is having more than 70% exposure into small cap category, and with this type of valuation, so it is definitely kind of very conservative valuation, and that helps us in the correction time. So when market falls, we don't get much hit. So it is, your risk is very much restricted, while your upside is can be infinite times.
Also, when you say your portfolio P, do you look at forward P or current P?
Trailing 12 months P. So current P, trailing 12 months earning, we discount.
At Care Portfolio Managers, I believe there are two strategies. One is the growth plus value, which is your flagship strategy. And the second one is large and mid cap strategy, which I believe was started 3 or 4 years back. Could you help us understand the difference between the two and how an incoming investor can decide which one to subscribe to?
So, large and mid cap strategy we launched in 2020. So reason was that when before that, for almost a decade, we were having only growth plus value strategy, which was doing very well. And at some point of time, many of our investors wanted to have some diversification. Second requirement was that we have around 30% business from NRIs, and they can invest through only one PIS. So one PIS cannot be linked with many other PMS players. So there were some technical need that arise that the client wanted to invest through us, but they wanted more diversification. And during the COVID, even the large cap, so-called large cap companies also went down. So it was very much in our comfort zone. So there were 3-4 things which were roaming around. So we concluded that let us launch large and mid cap strategy. That is also actually doing very well. That is also delivered more than 20% returns to our investors. So far, our exposure to our clients' exposure is only 5% to large and mid cap strategy. 95% are people invested into growth plus value strategy. In large cap strategy, large and mid cap strategy, our identification is more on the top-down approach. Like what we are having as of today, we are having more exposure to the pharma sector. We are having more exposure to the mining sector. So there our approach is going from the top down. We are having private banks in our portfolio. It is absolutely opposite of what we do in growth plus value, where 90% of exposure is on bottom up approach. If an investor comes to us, we say it is up to client's risk appetite. Both are my babies. I cannot be biased for any one strategy. One thing what I can promise is that be it larger mid cap company or be it growth plus value strategy company, fundamentals and valuations of the companies will be fantastic. Client need not worry about it. However, it is client's appetite, how much they want to diversify. As of today, we recommend that client should invest at least 75% in our growth plus value strategy and 25% in large and mid cap strategy.
Would it also mean that while the risk appetite needs to be different, should the incoming investor have a different time horizon for these two strategies?
Absolutely. Particularly for growth plus value strategy. See, in small cap strategy or small cap companies, you need to understand the life cycle of a company that goes from the undiscovered or unidentified to the top of the town. Okay, our investment mainly happens in the pre-discovery stage. Okay, so if I am buying a company, say Dawat Limited at 20 rupees, that another name of the Dawat is LT Foods. So Dawat Limited, I was buying at 20, seeing that there are entry barrier business. They are going from pure basmati play to value-added sectors and organic basmati. There are only 2 players, duopoly in the India, and having 50% exposure to the export market, mainly US and Europe. So that we had a story that okay, this is grossly undervalued and it can multiply your wealth. Today, after 3 years, it has crossed 400 rupees. They have ticked all the our fundamental and valuation criteria. But for quite a long time, it may remain at that price. So in small and small cap strategy or company and growth plus value strategy, we believe that if you want to genuinely make very good money, okay, time has to be, you have to give some time, like to see the story unfolding. Our observation will be based on the story that is unfolding. While market may recognize it today or later or after a few years, but market will have to recognize it and revalue that company. So to see the whole cycle, time is the most important thing.
I believe 35% of Care PMS clients are NRIs, primarily based out of the Middle East. How do they look at the India opportunity and the wealth creation that they can do in India listed equities? What is Care PMS's view on India and now and maybe in the coming decade?
Of course, there is too much curiosity and enthusiasm as far as the world is concerned. Everyone wants to participate in India's growth story. India, I think, for next 2 decades is definitely going to deliver very good returns. If you know, in large economies, India is the fastest growing. So India is growing at higher single digit, and it has a potential to cross even 10-11% kind of growth in next 2 decades. At some point of time, it will definitely have that kind of returns. For India or for any economy, there are 3 things which drives the economy. One is the fundamental, second is the liquidity, and third is the valuation. Particularly when you are talking about the markets that is replicating the economic growth. So result of the financial market will be based out of these 3 parameters. We are quite confident that fundamentally, because of the consumption story, because of our demography, because of our so much under penetration in many of the aspects of the world, we have a very good story for at least next 10-20 years that is evolving. Liquidity wise, if as of today there are only 15% of the working population who are investing in directly or indirectly into equities. In the developed world, it is almost 45%. So I believe if we add another 30 crores folios in next 3 to 4 years in the economy, and even they are adding only 1,000 rupees per month, which can be insignificant amount, we will have additional 30,000 crores per month available in the market. So liquidity I don't think has any issue. We call it financialization of the assets. Third is something where actually hamara kaam laega, where people will have to rely on some fund manager, because that is a part of the valuation. Growth is certain, liquidity is good, but at what valuation you want to enter? So valuation, like a pendulum, will go from extreme high to extreme low. If one has to play India story, he has to enter at right valuation to get the maximum benefit.
Arpit bhai, thank you for sharing your view on India and how you see the growth that is coming in India. Could you also talk about what is Care PMS's vision in, let's say, 10 years from today?
Of course, when I'm the first generation entrepreneur, we started this company, and we started with such a humble background. When after 3 months, even one client was getting onboarded, I and Amit used to get downstairs and have one ice cream. So that was the beginning. From there, we crossed 1,000 crores. From here, we believe that in next 4 years, we should cross at least 5,000 crores of assets. However, the growth of assets is not the driving force for us. We have seen things and things of the markets, and with Care PMS also, it was at one point of time, 2017 till 2017, it was best performing PMS player in India. We were delivering 33% CAGR.
Wow.
And during the time of COVID, it went down to the bottom quartile. So we have seen everything. But what we believe is that, we will remain focused on the PMS side. It will remain a boutique PMS company. We may be looking for expansion through geographically expansion of our own presence as well as from the client sourcing. Like in India, we are planning to expand our branches in Ahmedabad or Hyderabad. we are getting very good inquiries for the associations. In global market, apart from GCC, we are getting very good traction in European market. We are visualizing that or we are analyzing all the options available with us.
Okay.
But with the target to have at least 5,000 crores in next 4 years. Among the two strategy, we believe that growth plus value strategies is our core. And that was the foundation of the company. Identifying small cap companies and make it multi-bagger.
Okay.
So we believe that even in this 5,000 crores, major funds will remain in the growth plus value strategy, and large and mid cap strategy may grow organically.
Arpit bhai, you explained us the Care PMS journey and how you've seen the thick and thin of the CAGR number from being the top performing PMS in India to where you are today. Could you also explain or comment on how you've seen client behavior changing through these cycles? And what would be your advice to existing clients of Care PMS and new incoming clients of Care PMS?
So that is very good question. When I started the company, I was reading more on the client psychology than on my annual reports, because majority of the decision in the stock market taken by the individual is based on the psychology and not on the merits. What we see is that there is always a euphoria or there is a severe fear. So similarly, the client's behavior changes. Many of the clients' behavior, I would not call it as 100% client's behavior, but many clients' behavior changes in this way. What happens in small cap, when you have a fund with more than 70% exposure to small cap, sometimes your portfolio may go down 15, 20%, 25% in particular year. On those years, clients, instead of putting more funds, they are waiting to recoup their capital and exit. So every time when, like during the fall of the COVID, during the fall of market and our portfolio during the time of COVID, I personally message each and every of 600 my clients I was having that time. Only 3 clients had a courage to add the funds. I would definitely recommend that clients should add the funds. If you have understood the philosophy of Care PMS, if you are comfortable with our investment strategy, if you are comfortable with the stocks that we select, then probably all the time is good time to add the funds. For the new clients, don't try to time the market. Of course, Care PMS is always a conservative valuer. So even in euphoria, our valuations are protected, but we don't know when the bubble will burst. So we may miss some good opportunity, money-making opportunity. And for all the clients, existing or new clients, we tell them that at least you give us 5 to 7 years time horizon to see the performance. So the time will take care of the volatility in the performance.
Arpit bhai, you have explained to us the market cap mix in the growth plus value strategy is more than 70% exposure in small cap. The number of stocks are 18 to 20, but the top 5 or 6 may account for 50% weight. Could you also comment on what is the sectoral mix, and is there any theme that you also follow?
See, as I said earlier, in growth plus value strategy, our 90% exposure is from the bottom up approach. So we are sector agnostic. We have negative list of sectors, all the promoters being Jain. We don't invest into liquor, leather or tobacco companies, or even 1% of the revenue is coming through those sectors. We don't invest into those companies. But otherwise, we are sector agnostic. In bottom up approach, even particular company or particular sector is not doing well, industry leader may eat up their competitors' market share. So we may have exposure to a company, the sector of which is not performing. So that is very much possible. In large and mid cap strategy, we have top-down approach. and we try to see the, where we see the industry tailwind in particular sector. We try to have 2-3 leaders of that sector in the portfolio. So that is about the sector allocation. We are very much sector agnostic, but with this kind of negative list, and for large and mid cap, we will go with the leaders.
You explained that Care PMS is sector agnostic when it comes to growth plus value strategy. Could you also comment on, do you invest in cyclicals? Do you invest in turnaround companies, especially if it's a P&L turnaround or a balance sheet turnaround? Could you in fact also explain this with examples?
So as I said, we are sector agnostic. We don't mind playing cyclicals. We made some investments on the industry tailwind in metal industry, etc., based on the cyclical turnaround only. On the fundamental side, bottom-up approach, we have invested in many companies where there were either P&L turnaround or balance sheet turnaround. I can recollect one example of, say, Eselia Kale, where we started investments in somewhere around 2012. That time management change happened. We saw that suddenly the margins from low single digit went up to higher double digit, 20-25 times EBITDA was growing. 100% profit was converted into cash and distributed to the shareholders. So we invested it somewhere around 100 rupees. In 2 years, we earned 125 rupees as dividend, and we exited at 700 rupees.
Wow.
So turnarounds are, there is a one, quote when people say turnaround seldomly turn
around.
Yeah, but for Care PMS, it has worked well.
Arpit bhai, earlier in some of the questions, you gave answers where you were explaining that the entire investment process is research driven and a lot of numbers are looked at. Is it only to do with numbers while selecting a company? Is there some kind of a quant algorithm that you have internally that you follow and you filter out all the companies to have some shortlist? Is that how it works?
No. At Care PMS, we don't have that quant theory. We will never have that theory as well, because foundation of the company is based on the research. So when you say research, it is not about the understanding the numbers. It is about going beyond the numbers. So what are the reasons behind the numbers? If we get convinced about that, okay, these reasons are sustainable to give good numbers, and market is normally ignoring those reasons, like change of management, change of product portfolio, change of geographical, production, etc. So if those are the, reasonable reasons which are sustainable in future, and that is giving good numbers, so we will buy that story. So our number analysis is at very nascent stage. Our deep analysis happens to go look beyond the numbers.
Arpit bhai, having spent all these years into evaluating small cap companies and successfully able to identify a lot of these companies that turned out to be multi-baggers over the years, I'm sure you would have gathered a lot of wisdom. Would you mind sharing this wisdom so that incoming investors get the right perspective while investing into small cap companies, though by appointing Care PMS as their portfolio manager? What's the right perspective that they should have?
See, investors should never ignore the fundamentals. What our observations over these last 13 years is that investors get interested into particular sector or company near at its peak, where after peak, either promoter or institution starts distributing those shares to the retail investors. So at the end, retail investors buy the stock based on the narratives instead of fundamentals. Care PMS is able to identify, good companies quite early, pre-discovery stage, what we call. Any investor, be it a small cap, and in small cap companies, it happens, because their fluctuation in the market price is so big. it is very difficult to control your temperament of not investing. That fear of losing out, fear of missing out is there in at the peak of the market in all the, I think, retailers' mind. So that needs to be controlled. At Care PMS, we control it by having this IC committee, having separate, always focusing on the valuation that we pay to the company. So we are not buying on the narrative-based theme. We are buying more on the fundamental themes.
Is that how you are able to maintain a portfolio PE of 25 or less, even during peak times?
Yeah. So during the peak time also, our weighted average PE has remained around 25 times. And that is giving us very good protection, downside protection. So if something goes wrong, we are getting very less impacted while we see very good growth in the portfolio.
Arpit bhai, I would like to point out the key takeaways for our investors. Please add if I have missed out on anything. I think the 3 key takeaways for investors who are interested in appointing Care portfolio managers or Care PMS as their portfolio manager. One is clearly that Care PMS are conservative valuers. Second is that they are aggressive in their portfolio, in the sense that out of the 20 stocks, the top 5 or 6 stocks would account for more than 50% weight. And the third thing is that they have a proven track record of identifying multi-baggers at a very early stage. Arpit bhai, please tell me if these are right, and please if you could give concluding remarks.
No, thank you very much. The boutique PMS is also one of the things, like investor would like to know, because we are very much focused. We have a skin in the game. All the promoters are the fund managers. So this qualifies is, someone wants a customized, sustainable service. And our track record has been for 13 years. That has done really well. And we see that, the market is giving very great opportunities. And research is a constant process. So as of today also, we have remained invested around 95% of our funds. So we see very good growth is happening. So all the investors are welcome who wants to multiply their assets. Thank you, Equity Math and Shashank, for having me on the show. Thank you again.
Also, sir, thank you a lot for your valuable time, and I'm sure this content will help a lot of potential clients of Care PMS know everything from directly coming from you.
Thank you. Pleasure.
For investors looking to invest in small cap companies, a few things that need to be understood are to invest at the right valuation, because generally small cap companies become very popular among the masses when they reach at their peak, and that is the time when generally long-term investors, institutional investors consider selling these stocks. The other thing to be taken care of is to be aware of appointing a professional to manage your portfolio in small and mid cap companies, since these are under researched, and not all information is available publicly unless you go and meet the management and go through their previous quarterly earnings calls and transcripts. So we really encourage investors to appoint SEBI registered portfolio managers to manage their portfolio across market cap.